If it feels like your dollar doesn't quite go as far as it used to, you're not imagining it. The reason is inflation, which describes the gradual rise in prices and slow decline in purchasing power of your dollars over time. The impact of inflation may seem small in the short term, but over the course of years and decades, inflation can drastically erode the purchasing power of your savings. Let's look at how to understand inflation and the steps you can take to protect the value of your money. I'll start by showing you a recent statement by Philip Lowe, who's the governor of the Reserve Bank of Australia. Mr. Lowe said, inflation in Australia has increased significantly. While inflation is lower than in most other advanced economies, it's higher than earlier expected. Global factors, including COVID related disruptions to supply chains and the war in Ukraine, account for much of the increase in inflation. But domestic factors are playing a role too, with capacity constraints in some sectors and a tight labour market contributing to the upward pressures on prices. The floods earlier this year have also affected some prices. So, how does inflation work? Inflation occurs when prices rise, decreasing the purchasing power of your dollars. In 1980, for example, a movie ticket cost an average of $2.89. By 2019, the average price of a movie ticket had risen to $9.16. If you saved a $10 bill from 1980, it would buy you two fewer movie tickets in 2019 than it would have nearly 4 decades earlier. And you might have to sell a kidney if you want the popcorn. Don't think of inflation in terms of higher prices for just one item or service. Inflation refers to the broad increase in prices across a sector or an industry, like the automotive or energy businesses, and ultimately a country's entire economy. The main measure of US and Australian inflation is a Consumer Price Index, CPI, which measures the percentage change in the price of a basket of goods and services consumed by households. In Australia, the CPI is calculated by the Australian Bureau of Statistics ABS and published once a quarter. Though it can be frustrating to think about your dollars losing value, most economists consider a small amount of inflation a sign of a healthy economy. A moderate inflation rate encourages you to spend and invest your money today, rather than stuff it under the mattress and watch its value diminish. Inflation can become a destructive force in an economy, however, when it's allowed to get out of hand and rise dramatically. Unchecked inflation can topple a country's economy, like in 2018 when Venezuela's inflation rate hit over 1 million% a month, causing the economy to collapse and forcing countless citizens to flee the country. Next, let's quickly talk about deflation. When prices decline across a sector of the economy and throughout the entire economy, it's called deflation. While it might seem nice that you can buy more for less tomorrow, economists warn that inflation can be more dangerous for an economy than unchecked inflation. When deflation takes hold, consumers delay purchases in the present as they wait for the prices to decline even further in the future. If left unchecked, deflation can diminish or freeze economic growth, which in turn decimates wages and paralyzes an economy. Next, we'll look at some of the scary varieties of extreme inflation, hyperinflation, and stagflation. When inflation isn't kept in check, it's commonly known as hyperinflation or stagflation. These terms describe out of control inflation that cripples consumers' purchasing power and economies. Firstly, hyperinflation. Hyperinflation occurs when inflation rises rapidly and the value of the currency of the country tumbles rapidly. Economists define hyperinflation as taking place when prices rise by at least 50% each month. Though rare, past instances of hyperinflation have taken place during civil unrest, during wartime, or when regimes have been taken over, rendering currencies effectively worthless. Probably the best known example of hyperinflation took place in Weimar, Germany in the early 1920s. Prices rose by tens of thousands of percent each month, which very badly damaged the German economy. Next is stagflation. Stagflation occurs when inflation remains high, but a country's economy is not growing and its unemployment is rising. Usually, when unemployment increases, consumer demand decreases as people watch their spending more closely. This decrease in demand lowers prices, helping to recalibrate your purchasing power. When stagflation happens, however, prices remain high even as consumer spending decreases, making it increasingly expensive to buy the same goods. The US experienced stagflation in the mid to late 1970s as high prices from OPEC oil embargoes drove inflation higher even as recession lowered GDP and increased unemployment. So, what causes inflation? The gradually rising prices associated with inflation can be caused two main ways: demand pull inflation and cost push inflation. Both come back to the fundamental economic principles of supply and demand. Demand pull inflation is when demand for goods and services increases but supply remains the same, pulling up prices. Demand pull inflation can be caused in a few different ways. In a healthy economy, people and companies increasingly make more money. This growing purchasing power allows consumers to buy more than they could before, increasing competition for existing goods and raising prices while companies attempt to ramp up production. On a smaller scale, demand pull inflation can be caused by sudden popularity of certain products. For example, at the start of coronavirus pandemic, the increase in demand for indoor, socially distant activities combined with the highly anticipated release of Animal Crossing: New Horizon saw the price of the Nintendo Switch gaming system almost double in some secondary markets. Because Nintendo could not increase production due to factory production halts from COVID-19, Nintendo could not raise its supply to meet rising consumer demand, resulting in increasingly higher prices. And then there's cost push inflation. Cost push inflation is when supply of goods or services is limited in some way, but demand remains the same, pushing up prices. Usually, some sort of external event, like a natural disaster, hinders companies' abilities to produce enough of the certain goods to keep up with consumer demand. This allows them to raise prices, resulting in inflation. For example, think about oil prices. An example I've personally been feeling for a bit now. You and pretty much everyone else need a certain amount of gas to fuel your car, but when international treaties or disasters drastically reduce the oil supply, fuel prices rise because demand remains relatively stable even as supply shrinks. So, how is inflation measured? As already mentioned, the most well known indicator of inflation is the Consumer Price Index or CPI, which measures the percentage change in price of a basket of goods and services consumed by households. In Australia, the CPI is calculated by the Australian Bureau of Statistics and published once a quarter. To calculate the CPI, the ABS collects prices for thousands of items, which are grouped into 87 categories or expenditure classes and 11 groups. Every quarter, the ABS calculates the price changes for each item from the previous quarter and aggregates them to work out the inflation rate for the entire CPI basket. To understand how inflation is calculated, this is an example published by the Reserve Bank of Australia. In this example, we calculate inflation for a basket that has two items in it: books and childcare. The formula for calculating inflation for a single item is inflation equals price of year 2 minus price of year 1 divided by price of year 1 times 100. Using the formula, inflation for each of the individual items can be calculated. As you can see in this example, for books, annual inflation was 2.5%, and for childcare, annual inflation was 4.7%. To calculate inflation for a basket that includes books and childcare, the ABS need to use the CPI weights that are based on how much households spend on these items. Because households spend more on childcare than books, childcare has a greater weight in the basket. In this example, childcare accounts for 73% of the basket and books account for 27%. Using these weights and the change in prices of the items, annual inflation for this basket was 4.1%, which is calculated as 0.73 times 4.7 plus 0.27 times 2.5. Too much inflation is generally considered bad for an economy, while too little inflation is also considered harmful. Many economists advocate for a middle ground of low to moderate inflation of around 2% per year. Generally speaking, inflation harms savers because it erodes the purchasing power of the money they have saved. However, it can benefit borrowers because the inflation adjusted value of their outstanding debt shrinks over time. All I know is I'll have to buy a few extra packs of mints for Taco Tuesday.
Hey, thanks for watching. If you liked this video, please like and subscribe. If you didn't like the video, that's okay. Please still subscribe and I'll continue trying to improve to win you over. We're just getting started.